We're doing another case study today. This is a very common thing that is very misunderstood when it comes to bank on yourself, the concept. And what if you have a large lump sum and you want to start a policy and it's going to turn into what's called a modified endowment contract or a MEC. And you might have an accountant say, you gotta avoid those like the plague. They're so they're so whatever. Um, but you like you're thinking, but maybe it does make sense. So what I wanted to do today is help you decide that. Just give you the real numbers, a little side by side comparison from a real person that I did this for, so you can decide what you think about a modified endowment contract. Welcome to the FIFE Movement. I'm your host, Amanda Neely. This is the only movement that helps you create your unique, feminine, and entrepreneurial path to financial independence. And I know some of you are listening right now and you're like, wait, what is a modified endowment contract? A little bit of history here. Back in the 1980s, a ton of real estate investors were not happy with what was happening in the real estate market at that time. So they moved a bunch of money into whole life insurance policies. And the IRS, the Internal Revenue Service, took notice and was like, wait a minute, what's happening here is like borderline tax evasion. We need to change some laws so that what they're doing, we collect some taxes on. So in 1987, they passed this new law creating the modified endowment contract. And every whole life insurance policy going forward has, for lack of a better word, a ceiling that's put on it that you can't go above, or else the policy becomes taxable. And there's been a lot of debate over should you allow your policy to become a MEC, a modified endowment contract? Should you stay under that ceiling? And the basic rule of thumb is if you can stay under that ceiling and avoid your policy becoming taxable, that's probably good. But in a few unique situations, the modified endowment contract might not be such a bad idea because um, you're only taxed on the growth, and you're only taxed on the growth when you access it. So if you caught yesterday's episode that I made for mom, it was a modified endowment contract. And if mom accesses the policy and there's growth, she would have had to pay taxes on that growth. Now, that might not be such a bad thing if she's planning on only using it in the case of an emergency, right? It's her safe money that's there for her if she really, really needs it. And as we like to say, you don't let the tax tail wag the dog, right? The growth that she's going to get, the death benefit protection, the accelerated death benefit protection, that is the dog part of things. And you don't let the little tax tail on the end, right, of potential taxes become a problem, right? And keep you from doing, all the other benefits of it. But what if you're younger? What if you're not, mom's age, right? The 66-year-old. What if, say, you're 45 and you've got this big lump sum of money sitting in a savings account, not really doing much for you, and you want to put it into a policy. You want to have, um, the ability to access it if you need it. You're not planning to access it very often, or maybe, maybe you are, but but you also know that these modified endowment contracts give you a 10% penalty if you're under 59 and a half when you access those funds. So if you put in that lump sum, you get some growth, then when you take a loan or you take a withdrawal, however you're accessing the money, you have to pay taxes and you get a 10% penalty on that growth. Why would you want to do a modified endowment contract? I'm glad you asked. So, again, this might not be for everybody, but I want to kind of dispel the myth and show why it might not be such a bad idea, especially because taxes are much lower than they have been in the past. And you're only taxed on the growth and only when you access it. Whereas like savings account, you're taxed on the growth every single year. Okay. But we have to factor in that 10% penalty to ask, is it worth it? So let me share my screen, and I want to show you some real numbers from a real person that I put these numbers together for. So this, make sure I'm sharing the right screen. Yep. So this person, 45 years old, female, has $100,000 that she just has sitting around. She wants to deploy it to build her business, in good entrepreneurial fashion, but also doesn't need all of it at once, wants it to be there in case she needs it, that kind of thing. So I showed her this example of putting the money into a policy. Look at this death benefit she gets 4 times, more than 4 times her initial contribution in terms of the death benefit. And look at this, the cash value is equal to her contribution. They the This policy is very unique. Only one company offers this, and I have special access to it that a lot of people wouldn't have access to because I'm special. And this gives her a guaranteed return of premium. So if she decided the next day to cancel her policy, she'd get 100% of her money back. And then it also allows her to keep funding it over time. We just did $100 a month as like an option, but she could do much less. She could do much more. Just giving her this as an example. And you'll notice that as the policy, as she puts more in, the cash value goes up. And here in year 5 is when she gets her first actual growth of the cash value. And then down here in year 13, she's getting, at that point, she would have put in 114,000, right? She's getting some good growth at that point. And then here in year 14 is where she turns that magical number of 59 and a half, and there's no longer a penalty to access her money. So what I did here side by side comparison wise is put the same dollars into a savings account, have that balance grow, not touching it, and pay the taxes from somewhere else each year as you go. And I assumed that she was in a 22% tax bracket. With that portion of her money, could be more, could be less, but for this person, 22% made sense for where she was in life and the income that she was getting. So here we add up, if we add up all of those, it's about $3,250 of taxes that were paid through that year 58, right? When the next year she's turning 59 and a half. So then I did some analysis here to explain these numbers for you. So here we've got the whole life insurance growth. So here all I did was take the cash value at year 13 and subtract all the premiums that she had paid to that point. So $37,000 of growth on her money. If she took all her money out right then at the end of that year when she is about to turn 59, right? Kind of worst case, when she's got the most growth, would have the biggest penalty. She'd pay $3,776 in a penalty. She'd also have to pay taxes on the growth. So that I did the same 22% on the growth. And then her balance of what the growth minus the penalty minus the taxes, her real growth is only 25,678. So that's the whole life side. Let's look at the savings side. Woo. So here we've got $14,000 of growth. Again, I let Excel do the math for me. I took the balance there at that year and subtracted all of the contributions to that savings account. The taxes paid here, I just added up all the taxes paid so far to that year. And when you take the growth and you subtract the taxes, there's $11,000 of real growth that she actually saw when you factor in the same way. So let me ask you, even with that 10% penalty, is the modified endowment contract worth it if she's going to get $25,000 of growth? Or should she stick with the savings account and get $11,000 worth of growth? And don't forget, she was also protecting her family all along the way with that death benefit, which when you have a modified endowment contract, a MEC policy, the death benefit still goes to your beneficiaries without any taxes due. That's pretty cool, right? Um, So, and of course, I took the numbers out further. We show people all the way out to age 95 when we're looking at this because one out of five people, I think, right now live to age 95, and more people are going to. So, we like to, kind of give that example. Although the savings account, it was pretty clear, right, by the time I got here, that it was whole life policy was far outweighing the savings account. And guess what? Because, it's a bank on yourself designed policy with a, company that offers what's called non-direct recognition. She can access her money to help grow her business when and how she wants to, and she doesn't lose the growth, which with the savings account, she would lose that growth because 'cause they're not gonna give you, the same growth on your money when you've taken it out to go buy inventory or invest in your business in some other way. Almost forgot to mention that part. That's a pretty big deal. I'm going to stop sharing and kind of wrap up today. Hope you found this example helpful. I know you might be 45 or 35 or maybe even 25. Um, you want to know, go into a modified endowment contract with clear eyes, having run numbers like this. And of course, you need a professional on your side that's willing to help you make these unbiased decisions, seeing real numbers in black and white. I would love to do that for you. There's also some really awesome other bank on yourself professionals all over the US and Canada that would like to help you. You can reach out to me or check out bankonyourself.com to connect with somebody that might be um, in your area or a better fit for you. Just mention that you heard about us through the FIFE movement. That'd be awesome. Um, yeah, thank you so much for joining me and for, being willing to think entrepreneurially about your future. Also, this whole idea of having safe money, like we've talked about in yesterday's episode and today, is very much a feminine idea of having that protection, having that comfort, having, that safe money that you can count on being there and that you don't have to put all your money at risk. So I encourage you to keep thinking along those lines. How much of your money do you want to be safe? But also, where do you keep that safe money so that it grows? That's kind of the entrepreneurial thinking part too, right? And then be sure you join me in the next episode. I've kind of mentioned this whole idea of you can take policy loans to have access to your cash to grow your business or cover medical expenses, whatever you need it for. Um, but I haven't really shared how I go about making a decision as to when I take a policy loan and when I don't. So I'm going to be talking about that in the next episode. Be sure to join us there. For now, thanks for joining me today. As you go about your day today, remember wealth is coming your way. Your quest is to prepare for using it well. If you found this content helpful, please hit the like button. We invite your feedback in the comments on the YouTube channel. If you're checking this out on the podcast, thank you for being here too. Be sure you subscribe and look for links to the YouTube show in case you want to see any of the numbers I was looking at in the video with the screen share. Um, and of course, visit fifemovement.com to connect with the community, get some additional resources to help you on your journey. I will talk to you again soon.